Most ethical failures in accounting are not caused by bad people trying to do bad things. They're caused by good people under pressure, relying on mental shortcuts they don't even realize they're using. In this video, you'll learn how cognitive bias affects judgment, especially in accounting and auditing, and why awareness is the first line of defense. Accounting ethics isn't just about knowing the rules. It's about how we actually make decisions. Bias influences estimates, judgments, and interpretations long before a rule is ever violated. That's why ethical failures can occur even when professionals believe they're acting appropriately. Bias is not a character flaw, though. It's how the human brain works. And guess what? Even infants have biases. A study from Karen Wynn at the Yale University Infant Cognition Center showed that babies only a few months old could pick out good guys and bad guys in puppet shows. If babies have biases, you can bet we all have them too. We rely on shortcuts to make sense of complex information, especially under time pressure, and ethical risk arises when confidence is mistaken for objectivity. Professional ethics exists to counterbalance, not eliminate these instincts. Humans are naturally wired to simplify complex issues. While that might make decision making easier, it can also lead us to oversimplify things, underestimating risks, ignoring potential consequences, or missing key stakeholders. Ever thought a problem was small only to find out later it was huge? Yep, that's oversimplification bias at work. One of the most dangerous biases in accounting, the deterministic bias. This is the illusion that we can control everything, like thinking we can predict the future when we can't. When we're overconfident, perhaps thinking I've seen this before, we think we're in control and underestimate risks, and memories of past experiences often distort our judgment, which is known as hindsight bias. VW's Dieselgate is a textbook example of how underestimating risk can have catastrophic consequences. Senior management at VW believed they could get away with rigging emission tests, but they didn't fully consider the costs, social, legal, and financial. We are wired to favor people who are similar to us, our group, our beliefs, our way of life. This is known as ethnocentrism, and it can lead to unconscious discrimination. It's the us versus them mentality, or the belief that people who think and act like me are better than those and that creates stereotypes and attributing negative attributes to those that are different. That can result in someone's hiring decisions being swayed by the assumption that our way is better. We've all seen how these biases can show up in workplace discrimination, whether it's gender, race, or even background. Ever agreed to something that felt harmless at the time only to regret it later? That incrementalism, where one small bad decision leads to bigger ethical missteps down the road. Think of it as the slippery slope to disaster. This can be seen in corporate fraud cases like Health South, where small decisions snowballed into massive accounting fraud. It's easy to make unethical decisions when we're under pressure, especially in a high-stakes environment. In accounting, time pressure often leads to shortcuts. A lead auditor trying to meet a tight deadline may miss key steps in the audit process. Or worse, in an attempt to cut corners, the auditor might send private info to the wrong client, an ethical disaster. But there is good news. Research shows that transparency and strong internal controls can keep us on the right track. When we feel like someone's watching, we tend to act more ethically. So the key is making sure we're being held accountable and keeping ourselves honest. Have you ever felt torn between doing the right thing and going along with what everyone else? That's cognitive dissonance. when our beliefs clash with our actions, leaving us feeling uncomfortable. This dissonance often leads us to change our beliefs to align with our actions, even if it means justifying unethical decisions. One example that we've talked about before is Betty Vinson at WorldCom. She was pressured to manipulate the numbers to avoid getting fired. Eventually, she justified her actions to ease the dissonance between what she knew was wrong and the need to conform to company demands. The bystander effect can also play a huge role in unethical behavior. We've all seen this in scandals like Harvey Weinstein, Jeffrey Epstein, and Sean Combs, where people knew what was happening but didn't act because they thought someone else would. And as an accountant, you could find yourself in a similar position if you witnessed unethical practices from upper management. What would you do? Would you speak up or would you follow the crowd? Now that you've learned about unconscious biases and the forces that shape our decisions, think about this. What would you do if you were faced with an unethical situation at work? The key to avoiding unethical decisions in accounting and in life is understanding your own biases, having a clear ethical framework, and sticking to your values even when the pressure is on. Stay aware, stay strong, and stay ethical. I hope you enjoyed this video about cognitive biases and how recognizing the signs is the first step in avoiding ethical failures.